Hi, welcome to BISP Solutions. My name is Sanjana. Today we'll understand the concept of revenue recognition. And let's start.
Hey everyone, welcome to This Explainer. If you're prepping for CFA Level 1, you already know financial statement analysis is, well, an absolute beast of a section. But honestly, revenue recognition is the foundation of it all. We're going to break this down visually, step by step, to make sure it truly sticks. So here's our roadmap for today. We'll cover the golden rule of revenue, jump into the super high-yield 5-step recognition model, clarify deferred versus accrued revenue, point out some major warning signs and exam traps, and finish up with some essential CFA pro tips. Let's get right into it. Starting with Section 1, the golden rule of revenue. Imagine a company sells a machine for 10 lakh rupees today. The question is, should they record that revenue right this exact second? Your gut reaction might be, yeah, absolutely, especially if the cash just hit the bank. But that's a classic trap. In the accounting world, it's a hard maybe. It literally all comes down to whether the product was actually delivered, if control officially transferred to the buyer, and if all the promised performance obligations are actually completed. Only when those boxes are checked is the revenue recognized. It all boils down to this idea. Profit begins with revenue, and revenue begins with recognition. Think about it like a domino effect. If that very first domino, the revenue, is manipulated or just flat out wrong, then every single profitability metric that comes after it is also completely wrong. You know, a lot of the biggest accounting frauds in history, they started right here with manipulated revenue. And that brings us to the formal definition. Revenue recognition is truly the beating heart of accrual accounting. As analysts, we have to constantly be asking ourselves, is this revenue real? Is it sustainable? It is never, ever just about when the cash lands in the account. It's strictly about when the revenue is actually earned. Moving on to Section 2, the 5-step recognition model. You're going to want to memorize this operational framework governed by IFRS 15 and ASC 606. It's heavily tested. Let's build this out using a software contract as an example. Step 1, you identify the contract, the valid agreement with the customer. Step 2, what are the performance obligations? Let's say it's a software license, installation, and 1 year of support. Step 3, determine the transaction price. Let's call it a clean 1 lakh rupees. Step 4, you allocate that price. Maybe 70,000 goes to the license, 10,000 to installation, and 20,000 to support. And finally, Step 5, you recognize revenue as each distinct obligation is satisfied. So that license revenue is recognized immediately upon delivery, but the support, that has to be spread out and recognized over the 12-month period. This right here brilliantly illustrates why ASC 606 can get so incredibly complex in the real world. Think about Apple. Selling an iPhone isn't just one simple transaction. It's a whole bundle of immediate and future performance obligations. The hardware revenue is recognized when they hand you the physical phone, but the bundled services like the warranty or software updates, that service revenue must be recognized over time. This is the exact kind of practical logic the CFA Institute wants you to apply. All right, Section 3, deferred versus accrued revenue. Timing is everything here, and it's a super high-yield topic for multiple choice questions. Don't mix these two up. Contrast a Netflix subscription with a consulting project. With Netflix, it's deferred revenue. You pay them upfront for the year, but the service is provided later, month by month. Because Netflix has your cash, but owes you a service, it sits on their balance sheet as a liability. On the flip side, accrued revenue is when the service happens first. Imagine a completed consulting gig where the invoice is still pending. The work is totally done, the cash is owed to the company, so boom, that creates an asset. Honestly, burn this quick visual summary into your memory right now. Cash before service equals deferred revenue, which is a liability. Service before cash equals accrued revenue, which is an asset. Knowing these binaries cold will absolutely save you time on the exam. Next up, Section 4, warning signs and exam traps. Let's put on our detective hats and see how this framework breaks down in reality. The sauce company's source graph is a perfect real-world example of how tough identifying performance obligations can actually be. They were wrestling with ASC 606 compliance because of manual billing processes, crazy complex usage-based pricing, and massive delays trying to reconcile data between Salesforce and NetSuite. It was causing major headaches for proper revenue recognition. But here's the wild part. After SourceGraph finally automated that whole process, their revenue recognition time dropped by a massive 70%. Monthly reconciliations got faster, and compliance improved across the board. It just shows how operationally demanding getting this stuff right is for modern subscription businesses. Because it's so complex, companies sometimes bend the rules. Keep your eyes peeled for these major red flags. Treat them like an insider cheat code for financial analysis. If revenue is skyrocketing but cash flow is completely flat, that's a huge warning sign of aggressive accounting. A giant unexplained spike in accounts receivable could be weak collections or maybe even fake earnings. High deferred revenues suddenly tanking might mean they're rushing fulfillment or manipulating the books. And of course, the ultimate red flag, recognizing revenue way before the product is even delivered.
And please, never fall for the trap of equating sales with revenue recognition. Exam writers love this trick. Remember, revenue follows performance, not payment. Sustainable revenue quality matters way more than an inflated revenue size. Just because the cash hit the bank does not mean it belongs on the income statement yet.
All right, bringing it home with Section 5, CFA Pro Tips. Here is your playbook for locking in those points. First, memorize the 5-step model. It's non-negotiable. Second, ground the theory in reality by studying companies like Apple, Amazon, or Infosys. Third, drill down hard on those deferred versus accrued multiple-choice questions. Fourth, and this is a pro move for real-world analysts, always read the revenue footnotes in the annual reports. Most fraud clues hide right there in the fine print. And lastly, leverage AI tools smartly.
Speaking of AI, tools like Microsoft Copilot can be absolute game changers. They can summarize annual reports in seconds, spot complex footnote policies, and compare deferred revenue trends to flag weird patterns, like rising revenue paired with weak cash collection. But keep in mind, while AI can detect inconsistencies incredibly fast, it only supports analysis. It literally never replaces your own professional judgment.
So I'll leave you with this one critical thought for your studies. If a company's revenue recognition is flawed, can you actually trust a single number that comes after it? No way. If the top line is wrong, gross profit, operating income, and net income are all wrong too. Mastering how a company earns its very first dollar is the ultimate key to understanding its true value. Thanks for hanging out with me for this explainer. Keep practicing those 5 steps and you are going to completely crush this on the exam.